All right. Good morning, everybody. We're halfway through the week, and it feels like a Monday. That's just me. The market is waiting on the 10-year. You know, sometimes we talk about those auctions, and it feels like I'm the only one that does it. But it's easy to forget that they have impact because a lot of the times they come and go, and we really don't see anything. And FX Street has those auctions usually listed as this really light impact. And so people just kind of forget about them. But not today. Today we're going to get the 10-year, and there's been a little bit of an academic discussion, I suppose, a hypothetical thesis that due to the QRA and what Yellen did, and then the reactions after FOMC, that there might have been a little bit too much. And we're going to find out today. So watch the clock. 1 o'clock today has the potential to look like one of those QRA days that we had last week. And it's going to catch a lot of people by surprise. They're not going to know. And, you know, some of the best trades we get is when people are caught off sides. The institutions are not going to be caught off sides, right? We got that because they know it's coming. They can hedge it, whatever. But the masses of the uninformed retail trader sitting there trying to get it done at 1 o'clock, they're going to get run over. Stops will be triggered. Markets will gyrate, and volatility is our friend. So it's a good thing. The Russell is down the most this morning at 0.5%. Europe right behind it. The Dow is basically flat. Japan barely in the green, but just as flat. Right next to the S&P 500 and the NASDAQ, all waiting on the 10. It's at 1 o'clock today, Eastern time. Nobody cares where you live, right? We all trade the same market, so we all talk the same time frame. This was likely to be the biggest event of the week, but we're going to be getting some initial jobless claims tomorrow that hold a little bit of weight because of last week's job numbers. So this now, between the 10-year today and those job numbers tomorrow, I wouldn't say it's a toss-up. The 10-year today very likely has more impact, but that's the next one up. So we're going to have the 10-year issue today, and then tomorrow morning we're going to have those initial jobless claims, and that's pretty much going to be it. I mean, sure, there's more econ on deck for the rest of the week, but these two are the biggest. All right, so we get these out of the way, and then everything else will be all right. We are going to get data out of Japan tonight. Remember that we're watching US dollar Japan really close. We don't really hear much of the saber rattling right now, but they don't want to see things get up into that 152 range, right, on US dollar Japan. And we keep holding and hovering around that 145, 149 zone. And every bit of new data we get, to me, always has me circle back and ask, is this going to be the straw that finally breaks this camel's back? We don't know. Talk about being caught off sides. We just don't know. So we're going to get a lot of data tonight. It's worth keeping an eye on. It's worth considering when you look at what you're holding. When's it due? All right, is it options? Is it going to expire? How much time do you have left? And could your trades tolerate a 3% move in the S&P? Just run a beta weight against what you're holding, turn all your deltas into SPY deltas, and then compare it to a SPY move, and you'll have an idea of what you're holding and how it's going to be impacted if the S&P moves. It doesn't matter if you have stock or options, and if it's in, Amazon and Caterpillar. That's what beta weighing is all about, right? Turn everything into apples and then compare apples to apples. Stop talking about food so early in the morning. I'm gonna get hungry again. Alibaba misses on earnings. Well, they've been dragging along the bottom. I guess there's nothing wrong with dragging along that bottom a little bit longer. We have a lot more Fed speakers tomorrow than we do today, but we've got some Fed speakers today too. So, don't let that get overshadowed by the 10-year. We're going to have European central bankers, Bank of England bankers, and US Fed speakers today, tomorrow, probably through most of the week. So the hits just keep coming, right? Kind of flipping through Spot Gamma, they didn't really have too much to say other than with the contraction in the market prices and the way the options are laying out, the market is getting strangled basically by options on each side tightening more and more. But they did mention that the S&P should be well supported while it's above 4,900. However, underneath that level, they believe demand for long puts and long volatility would increase. And so if we do break 4,900, we could expand relatively quickly. I don't necessarily want to call it a flash crash per se, but we've seen those kind of moves before. So 4,900, and look, it's not just like, oh, well, we got there, so we're going to crash. If we get below it, and remember, liquidity resides on the other side of the pivot, we'll just consider this our pivot. If we get there and we overshoot it and we get underneath 4,900, it's not time to load the boat with puts, because we can easily get down into that liquidity and rebound right back up again. It's the idea that if we get down below it and it looks like we're going to sustain a move lower, that's where things are really going to start to pick up. All right. So don't set an alert and be ready to buy just because we get down into 4,900. Ready to buy puts, I mean. Other than the Fed speakers, we have 8:30, 10:30, 1 o'clock, 3 o'clock. These CPI and PPI are going to be coming out of China. That's another thing on the table too, is China is trying to stimulate like crazy. They're the opposite of what we're doing, right? We're trying to stay in restrictive territory with these higher rates and not necessarily burden businesses, but dial things back a little bit. And China still got that Evergrande situation, which the contagion continues to spread. And they had more than 20% of their entire stock market go limit down earlier this week. Think about that. Have 20% of the S&P drop so far, so fast that it triggers lock limits on the day. Sounds like some good times, right? Yeah, you like it. I like it. Volume this morning is a little light. That makes sense since they are sitting out waiting for the numbers. They want these 10-year numbers. It's kind of a big deal. So, are we going to stay range bound all the way until 1 o'clock like a CPI day or like an FOMC day? I don't necessarily think so. I think there's enough other stuff between now and 1 o'clock that cause volatility that could get us moving around. But the range is pretty much set. We've got our high thanks to that Globex spike last night when there was data. And we got our low, a very awesome low, by the way. I mean, look at how the market was addressed every time we got down into those lows. A couple of my trades yesterday were based right on those lows, because why not, right? If they're going to give it to us, we'll take it. So that is our definition probably until 1 o'clock, right? We could, again, wick down through the levels or wick up through the levels because liquidity resides on the other side of the pivot. But we're not expecting to expand beyond those levels at a significant pace until the 10-year. What would make that statement wrong would be if one of the Fed speakers come out and say something that really galvanizes the market in one direction or another. That would certainly push us through either one of these two levels and send us further. There's not really any economic data between now and 1. So it would have to be the Fed. If one of those Fed speakers, and it doesn't even have to be a US Fed, it could be European Central Bank, Canada, Bank of England, one of those guys gets to chip in teeth, say something they shouldn't say or in a way that a reporter misunderstands, they could print something that spikes us through these levels. Otherwise, we're going to wait on the 10-year and go from there. We still have the ADR on each side at the moment with this drive higher. It looks like we're more likely to hit the upper ADR half first before hitting the lower. But, if we take away all the nerdiness and, the scientific fancy, we just take it down to the basics. Average daily range, ADR. How do we get this magical number? It's a 21-day average of what the market does. 20 days, a market month. What's the market done in the last month? It went up X amount and went down X amount. What's the average daily movement? Those red lines. So what do we do on a day-to-day basis? We go to one of those lines. Now I can point out examples where we didn't, waiting on FOMC, waiting on the 10-year today, even that Monday when we were waiting on QRA. So we're not guaranteed to go one of those lines, but more often than not, that's what we do. Why? Because that's the market's average move. It's going to do what it does on average, unless there's a reason to believe otherwise. If we get to one of those red lines early enough, it doesn't necessarily mean that we're going to continue on to the yellow line, which is the full ADR. Instead, it's more likely that we turn around and we go to the previous line. So if we get to the bottom early enough, we can go to the top, or vice versa. We get to the top early enough, we can go to the bottom. This breakout this morning in the Globex was a breakout on the week. Monday had already been broken by Tuesday, and now Tuesday has been broken by Wednesday. So we're getting higher highs, and we're so far getting higher lows. Trying to recover after this significant dump into the close on Friday. And Friday's levels are still the levels to get through, 49.97.5. Where IX10 inside this really big bar, which doesn't do us any good. But we're also IX10 inside this red bar. That's not as bad, but it's still not as good as I would like. I'd like to be IX10 inside of this small bar right here. But we're only inside day and we've already broke out of it. So not a lot on that front. Notice they're not hedging yet. The volume is light. They're sitting out, but they're not hedging yet. If we want to continue to monitor them to see if they're going to begin hedging later in the morning, watch these two numbers. We're looking at the front expiration, the things that are going to expire today, versus the next expiration out, the thing that's going to expire tomorrow. If the front number here on the implied volatility average gets higher than the next number out, we'll get a market maker move show up right about there. If you're on a platform that doesn't have a market maker move, you can just look for these two numbers to get inverted. And then you'll have a market maker move. That implies hedging in the front end. So we don't have it yet. It doesn't mean they're not hedging per se, just that it's not heavy enough yet to trigger a market maker move. When we get closer to 1 o'clock, if they are in here trading in the front end, protecting their positions and hedging, then we'll begin to see it. It'll show up as a market maker move. 10-day, 30-minute volume profile, something I haven't reminded people of for a while. When we're at the lows, we expect to go to the highs. When we're at the highs, we expect to go to the lows. That's a misleading statement, and this is a misleading indicator. For an example, this low down here, it looks like we came down and we hit this low and we bounced off of it. This high here, it looks like we ran up and we hit that high and we bounced off of it. That's not what happened at all. If we rewound 4 days ago, in fact, you can go through the morning briefing and see what the volume profile looked like at that point. We didn't hit something up here, not on this profile anyways. The ES may have hit a pivot, maybe one of its inverse markets or some other market hit a pivot, but the ES didn't hit the top of this profile and pull back from there. It created that top as it ran up and then fell away from there. It's very likely that there was also price already higher than this at the time. So I bring all that up because the volume profile used on a 30-minute 10-day like this can be a little misleading when you don't think about these past days. So today, this morning, the only thing that is relevant is where we are right now and these levels that we can look at. We can't look at anything else back here and say, oh, wow, look how it respected how it got tangled up in the point of control or how it hit that low. That point of control is there now. We don't know if it was there when these candles printed around it. Right? So you don't want to do any of that kind of analysis of looking back and saying, what did it do back here? Just where are we now? And how can these levels affect us? If you don't quite understand what I'm saying, take a picture, say at 7 a.m. Tomorrow, take a picture at 7 a.m. The next day, take a picture at 7 a.m. Do that for a week and then compare those pictures. And you'll begin to grasp the logic of this. I did it for 30 days because I'm stubborn. And went back and compare them all, and you'll start to grasp this logic, right? So it only has relevance now. And we can't look back here and consider how it may or may not was affected by the profile. We have a new VPOC line. Yesterday, we set one low enough on the day that once we drove above it, and left it behind, we now have one down there to deal with. Too far. $49.60 and then 3 ticks, maybe $49.61. I mean, really, if we zoom in enough, we might find it. I got the mid. Okay, that'll work. I wouldn't stress on it, right? One tick one way or the other, it's never really going to matter. One tick. So if we do make that move to the downside, we're expecting at least a first touch play. And this is as good of a time as any. You see how we're running up into this previous level. Liquidity resides on the other side of the pivot. So if we do shoot above it, are we going to see a big volume print, even though we don't get a big TPO print? That's why we run both of these side by side. Can help you identify if we hit a ceiling, or if this same thing happened in reverse and was along the lows, it would help us see if we hit an iceberg. Consider what it's going to mean if price gets up here, tags that line perfectly, and falls back. We'll just use this because we don't get many great opportunities like this. So to help you answer that question, this pattern, it's a cup and handle. That pattern is a double top. Double tops are bear traps. So we want to get the bull traps. We want to get the bulls up here, make them think we're really breaking out, do a rug pull and send it back down. But we have to get up here to convince them to get in so that we can trick them. It's not much of a trap if we can't trick them and convince them to go long so that we can rug pull. If we come up and hit the line perfectly and we come back down, that's not much of a trap. It's not much of a double top. It's not going to convince any of the bulls to get in. It's very likely we're forming a cup and handle instead, and we're going to get about a 1/3 pullback right into that support level probably. And then we make our move to the upside. So if you are long in this and then you're starting to get nervous and you get out and then you're looking for a new entry, catching that pullback for your long is a good shot. Heck, just taking the counter shot, the first touch rejection pullback usually gets you a couple points, and or waiting for it to break out to continue to the upside. If it does break out like it does here, it is now, then you want to wait for that signal that tells you this is really a double top so that we can trap the bears and run it back down. Remember that when we're waiting on any event, FOMC, the 10-year, whatever, we want to sell into strength and we want to buy into weakness. So we don't buy the dips, we sell the rips. Here's a rip, we would sell this, but not blindly, right? We don't need to wait it, let it tell us that it's done. .32% above the 10-week. We are continuing to ease down a little bit. We've been higher than this, so we're not overbought per se. We're stretched out pretty far though, looking at how often we've been higher on the 10-year than this. There's only been a few times in the last year. They didn't last very long. So it's not an immediate dump kind of a threat, but it's hard to see a path higher from here without getting a better reset than we've had at this point. If you look at these spikes, they're usually little islands or towers all by themselves. We spiked up and we fell back down. That we didn't get there and linger, although, a little bit here through that holiday season. generally we get above that 4%, we're just come right back in again. That's a little bit of that mean reversion and moving too fast and coming back. But we can also see that we spend a considerable amount of time between 2 and 3%, that we just hang out there, that when things are going good, we don't come back and touch that 10 much. So we're a little overbought. We're a little out there, but it doesn't owe us any pullback. And we're kind of sitting in the sweet spot. We can just jam here between 3 and 2 and continue to do our thing. So this is all about the weekly. Let's swap it over to the daily. We're not even 1% away from the 1-day moving average or the 10-day moving average. So we're definitely not overbought. We haven't moved too far, too fast. It doesn't owe us a pullback at all. Looking at this, we're slowly outpacing that 10 to the upside. So we're working on expanding that distance. We're back above Friday's close. We still have to deal with Friday's high. And then we have the high of the week. 50.32 is a cog line, and 50.33 is the range for the week. It's the expected move. Not really expecting much out of the market this morning on this hurry up and wait for the 10-year. We've got solar, which is interesting that we have that, but I don't see a lot of China ADRs because the solar's been doing good with the China ADRs. And now what we have solar without them. A lot of those look like they were the very definition of a short squeeze. So it could just be, you know, a little bit of that. To the downside, we don't have anything at a 0.5%. So this is really just a perfect example of a market waiting on data. Hurry up and wait. It's a little bit of a warning, I suppose, for anybody looking for an opportunity to trade today. If you're struggling to be a profitable trader, day trader, I think this morning would be a morning that you'd probably do better not trying to trade. I know nobody learns how to trade just to not trade. So we got uranium, nat gas, and solar energy of various forms. Even though the XLE is basically flat, which is telling us is probably, you know, crude, right? But we can see a little bit of crude here at 0.4. China down, pot stocks, bonds, silver, all of those are down this morning. Bitcoin is on its way to being down enough that we can count it, but it's not quite there yet. So at least we have some negativity out there. I don't really care what direction we go, right? Up, down, just give me some clean price action to trade. Yeah. So that's it. It's not rocket science, right? Today is going to be watch the clock, listen to what the Fed speakers have to say to see if they, you know, maybe try to walk around anything that Powell said, and get ready for the 10-year auction at 1 o'clock. That's what I got for you.